Every now and again, a location comes along and completely redefines a real estate market. And for over a century in New York City, that location has been Central Park. In recent years, the properties bordering its edges hit valuation levels never before seen in Manhattan. I mean, $240 million for a single penthouse sale, that is pretty much unheard of. Now, I study Manhattan real estate, but I'll be honest, even while making this video, I looked at the historical numbers and thought, this is unreal. Many trends tend to fade given enough time, and, well, looks like I was wrong. Every few years, Central Park's front row properties are still commanding record-breaking price per square foot numbers. So I decided to dig a little deeper into the forces driving this. And it turns out the strategy behind investing in this location is by far even smarter than I first thought. In this video, I'm going to show you the most historic patterns that have kept Central Park's luxury corridor at the top of the market for the world's wealthiest investors for several decades. Since the last spike, the buyer psychology around Central Park has only heightened ahead of competing landmark locations. The strange thing is, on the surface, it looks like nothing is changing. The skyline occasionally shifts with an occasional new luxury tower. But as you'll soon find out, that's intentional. In many ways, maintaining dominance in real estate isn't about flooding the market. The top developers and investors understand it's about controlling scarcity and attention. The best value properties around Central Park come to market in a way that does exactly that. And through my research, I discovered 3 historic patterns that drive the best investments. In just a minute, I'll show you some of the most incredibly predictive trends at play here. But first, we need to address something. Why do some of the most intelligent developers in the field still find themselves getting stuck chasing a market and slashing prices? I mean, most of the time, they have sold out numerous high-end buildings before building around Central Park. And in a market like New York, that's no small feat. So why does it happen? Well, that takes us to the first historic pattern. Developers overbuild.
Now it's a lot of just terrible smells and the noise is incredible.
Developers have planned a behemoth luxury apartment building, nearly the height of the Empire State Building. The size of the building, the noise, and the dust have neighbors upset.
The real estate industry has really been behind it, and they have wanted to build speculative towers for years and years, and they do so, and they have convinced politicians, I think, that that is the only legitimate kind of economic development that we can do in New York.
You see, when a marquee developer is seeking their next play, they are often predicting demand where it's hot. You want to build where everyone wants to be. It appears as a straightforward formula. Run the numbers based on recent trends and projected demand in a desirable area, develop the property, buyers buy up the units, and repeat. It's worked this way on several properties before, so they run the same play. But when the market is hot, multiple developers build all at once. They aim high. They go for record prices. They open towers that get their own headlines. And for a while, it works. Then suddenly, there are more luxury homes than luxury buyers. The air thins. Days on market gets longer. Price cuts show up quietly. Some sales fall through. And the amazing, famous front page buildings start to feel heavy. Does that mean the buildings are bad? No. I mean, timing is everything. In boom times, even the best tower can get ahead of itself. Manhattan has seen this more than once. In the late 1980s, more and more luxury towers opened just as the stock market shock cooled big bonuses. The towers were still special, but there were more units chasing fewer buyers. Years later, a similar thing happened again when a line of ultra-tall buildings launched close together south of Central Park.
Well, I think you're looking as much as 5 years to work through what we call shadow inventory, which is condominiums that have essentially not been able to be absorbed in the market since the fall of Lehman and the change of the credit situation.
At first, those launches were huge news. But soon after, you could see price cuts and longer selling times showing up in public reports. It wasn't the fault of one building. It was the weight of the whole wave. So how do the world's wealthiest handle this? They pay attention to the data. They look at how fast new listings get signed. They watch how many homes are still unsold a few months after launch. They listen for a tiny shift, from lots of new listings, slow contracts, to fewer listings, faster contracts. That shift can be sudden, where suddenly supply starts to diminish. When that happens, the best units in the best towers start to move again. And when they move, the rest follow. When you break it down, the process may seem straightforward, but there are a lot of market dynamics at play. Many times, times, these larger forces at hand go well beyond the buildings themselves, which takes us to the second predictive pattern: sudden events. Big ones, the kind that make people freeze.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points.
They're calling it the Monday Massacre, the worst drop in Wall Street history.
Almost double the rate of the Black Monday that signaled the beginning of the crash of 1929.
A few moments ago, something believed to be a plane crashed into the South Tower of the World Trade Center.
By now, we know that big shocks to almost any property market can reshape prices rather quickly. They're basically the city's way of showing where the next real opportunity is. Here's how it works. A major event hits. It could be a financial shock, a global health scare, or a local weather crisis. In the first weeks, the market gets quiet. People wait. Some sellers need to move anyway, so they cut prices. Then the headlines get loud. That's the first stage. Then little by little, the city finds its feet again. Jobs return, flights return, schools return, people come back. And in that second stage, the well-located homes and well-known buildings start to trade really well again. And in the third stage, the market doesn't just recover, it completely overshoots. Prices past their old highs. People who bought during the quiet know exactly why they did it. But it's not just about waiting for a dip to buy. The real key is spotting the outliers. Let me explain. If we looked at sales data after a disruptive event, say a financial crash or a citywide shutdown, the average rebound for prime Manhattan property might be 5 to 6% within a couple years. A good rebound, maybe 10 to 12%, but the outliers, those rare recovery runs of 20% or more in the same time frame, those are the ones that change portfolios. These outliers have a massive edge in that there is significantly less competition for deals, and the payoff is magnified. Sometimes the difference between a 12% and a 25% rebound isn't luck at all. It's having the nerve to act when others are hesitating. If you can identify the first signs of recovery, you're locking in before the public narrative changes. History shows that once the first few months of improvement are visible in the data, rising contract signs, lower days on market, buyers are more likely to commit, and the window for deep discounts starts closing quickly. During the 1987 crash, Central Park West Trophy Co-op saw a drop of 10 to 15%, but within 2 years, they were back to peak. Those early months were where the magic happened. Units trading off-market at a fraction below their long-term value. Perhaps even a better example of this principle in Manhattan, the post-9/11 rebound along Central Park South. For nearly 2 years, demand froze, vacancy spiked, and even prestigious buildings saw offers completely vanish. By 2004, the rebound wasn't just complete, prices were 20% higher than before the attacks. And then comes the real moment that cements the pattern trend: COVID-19. By late 2020, billionaires' row vacancies had increased by up to 50%, and ultra-luxury units were 20 to 30% below their peaks. Those who stepped in 2020 saw 25+% gains by 2024. The smart money didn't wait for a headline announcing Manhattan market is back. They were the headline months later. Notice something? In each of these cases, the boring months, the period between panic and recovery, are the ones that deliver the best returns. That's the part most people skip because the headlines are still negative. Smart buyers cut that noise, focus on fundamentals, and make a move. The pattern has been consistent for decades. Shock causes fear, fear creates discounts, discounts lead to early recoveries, and those recoveries offer multiple windows to cash in. It is a short window. It might last a few months, it might last a year, but it closes fast. After big shocks in the past, contract activity in strong areas often stop falling before prices turned up. That's the tell. Signed deals stabilize first. Price follows later. If you wait for a headline that says recovery is here, you're already paying the new price. And now onto our final historic pattern. Scarcity and status drive faster rebounds. Properties along Central Park or a short block away tend to fall less and recover sooner. And when they recover, they often climb faster than the rest of Manhattan. There is only one Central Park. There is only so much frontage. You cannot build more of that view. People across the world know this. So when the market finds its feet, buyers often chase the shiny object first. Think back over the last many decades. In rough periods, you could find headlines saying New York was over. And yet soon after, record-breaking prices and bidding wars were abundant. Not every building and not right away, but the pattern held. Scarce, famous, high-trust locations found their way back into ultra-high net worth buyers' hands. If you learned anything from this video, please smash that subscribe button. And also, YouTube and I think you'll like the next video. Let's see if they're right.